Real estate has made more millionaires than any other asset class. But in 2025, you need to be aware of all of the pitfalls that are happening and are right in front of you. If you're not ready for this, you're going to be stepping right into a meat grinder. So, in this video, we want to show you exactly where the landmines are sitting at and then what you can do to prevent them. I'm Anton Stetner. I've been investing here in the Seattle Metro for over 20 years. We helped tons of clients make tons of money in real estate. This is what we're doing, and we want you to be aware of this because some of these items have hurt us, cost us money, and future opportunities. So let's pay attention to them together. Number one, we have what we call the rate whiplash. This is where rates feel like they're moving in a certain direction, and then boom, they pop up. All you have to do is go back and look to rates pre Liberation Day and right before it looked like Trump was starting to win because rates were both trended in a downward direction. All of a sudden, rates shot up. The Fed also cannot commit. They are saying we are data dependent. They're feeling very political right now. But the moral of the story is they are not going to cut rates until they know inflation is under control and that tariffs are not putting upward pressure on those rates. So the Fed is just kind of paused. And what you're waiting for is the market to create that certain level of certainty so rates remain constant. So what I want you to do is I want you to model into your pro forma, what if rates shot up by 0.5%? Because that has already happened this year. Would it kill the deal? If you're not modeling the downside at 0.5% or a 1% increase in rates, then you're not investing. You're just simply guessing and taking risks. Number two on the list is cap rate compression and overpaying. See, the seller still wants 2021 pricing. The buyer wants 2025 pricing. And rates suck. So we've got this delta in the middle. Cap rates have been trending in a downward direction. The cap rate is essentially the yield that you're getting on that property. Cap rates were really low when interest rates were low, but cap rates have started to rise. The question, though, is what if cap rates have not hit their peak? And I believe they haven't. We need a little bit more bad economic news. We need the economy to slow down just a little bit more. As that happens, cap rates will continue to rise to compensate. Also, you have to find the motivated seller. The seller who's not motivated and doesn't have to sell is not going to give you the cap rate you need in today's market. So, if you want to not overpay, all you have to do is look at the asset like it's performing at, for conversation's sake, a 5.5, and then simply look at what would happen if the asset was performing at a 6 cap. You will see a major change in those valuations. Cap rates don't lie, but they do compress when sellers start to get desperate or when economic factors start to put external pressure on them. So think about, I'm not buying a property, I'm buying the risk. And don't get seduced by the listing brokers, super sexy pro forma. We got to assume all those numbers aren't really working. Number three is the tax law ambush. See, the big, beautiful bill passed the House, but there's no guarantee it's going to pass the Senate. So 1031s are always under scrutiny. They're always under attack. And we know the U.S. needs more tax revenue today. So don't make your investing strategy for 2025 all about 1031s and bonus depreciation. We believe the 1031 will always be there, but we don't know if 100% bonus depreciation is coming back. So don't put that into your pro forma. Then if it comes back, if the Senate votes it through, all of a sudden it becomes something even stronger and you win. Allow the pro forma to win based on today's laws, not tomorrow's guesses. Number four, insurance is the silent killer. Insurance has been increasing all across the United States, and there are some areas of the country that have seen this massive jump in their premiums. And I'm talking places where they have a higher likelihood of wildfires, where they have a higher likelihood of tornadoes or hurricanes or flooding. You've seen this really happen definitely in Florida to condos, but just be really aware that insurance premiums are massively rising. And so in your pro forma and in your numbers, you need to put in a higher insurance cost than what the seller currently has. Also understand, if the property is not insurable, it is not sellable. That greatly diminishes the value. So if you struggle getting insurance, the next buyer is going to struggle getting insurance. Therefore, you would need to get a discount in order to purchase that property. Number 5 is what we're calling regulation roulette. I'm talking rent control, eviction bans, zoning moratorium. This is city by city, county by county warfare and the NIMBY warfare. The NIMBYs are the not in my backyard people who are trying to who are trying to prevent you from getting something now, because see, once they've got what they have, they now want to prevent everyone else from getting it. Your cash flow in the future will mean nothing if you can't legally raise the rent. To give you an example, here in Washington State, we just passed rent control. Rents cannot go up more than 7%. Now you say 7% is a lot, but what if you bought a property and they were 5 years behind on raising rents, and your goal was to rehab the property and raise all the rents? You wouldn't even be allowed in Washington State anymore to get that all the way up to market value. You'd have to put in the pro forma that you were going to raise it incrementally, which may cause more tenant turnover, which means you're going to have to get more of a discount. As we go through all the items on this list, there's going to be something I miss. Please drop that in the comments below. Share this with a friend that's thinking about investing in a property, and hit that magic subscribe button for more videos like this. Item number 6 on the list, I'm going to say, is AI is coming for your margins. See, we're not Blackstone. We're not the iBuyers. We're not BlackRock. We're not Invitation Homes. You and I are what we call the small investor. And so we don't have an unlimited budget to pay for AI, who can then manage all of the underwriting, all of the analysis, all of the rent control. The small investor is still using Google and spreadsheets, and the big investor is coming after your margin. So just be prepared that you are going to continue to get consistently pinched over the next 5 to 10 years by people that just plain have more data and more money to throw at the problem. Conversely, when you flip that around, that will always create your opportunity. When the big boy or the big girl, the hedge fund, is playing, there will always create a small niche around where they are unable to play. 7, we got to talk about construction bottlenecks. If you try to remodel anything during the pandemic, you know exactly what I'm talking about. Home Depot was out of your favorite flooring. You couldn't get a contractor to come. Well, what's happening to the U.S. as a whole? Our labor force is aging. Our material supply chain is slightly unstable because of tariffs. And we are losing some of our labor right now due to immigration policies. Not to mention that timelines at your local municipality to get a building permit or to get a development done are just plain a joke if you live in a blue state like we do here in the Seattle Metro. So value add isn't dead. Building new homes is not dead. Just realize it's a little bit more risky in 2025 than it was previously. Number 8 is what we're calling the liquidity trap. Interest rates are up and buyers are down. As interest rates come up, there are less buyers that qualify. And so we have what we call the lock-in effect. The lock-in effect doesn't apply just to regular home sellers. It applies to me and you, the average investor who owns a duplex, who it doesn't make financial sense for us to sell that duplex today and go purchase the next one. So make sure you are running your numbers extra good and extra tight, and putting in some of these contingencies that we've already talked about, because it may not make sense to sell that existing asset today in order to purchase the next one. Now, it will make massive sense when you've got a great value add or additional value opportunity, such as building a DADU, building an ADU, adding more units, subdividing, rezoning. It's going to have to be something major, though, because some of your assets, I'm sure just like mine, are sitting at around 4%. So it doesn't make sense to trade in a 4% asset for a 7% asset unless I've got massive upside today. Number 9 is inflation, and let's call it stagflation also. These are our silent margin killers. This is the boogeymen. They haven't gone away. So even though the last inflation report came out and it showed inflation was trending in a downward direction. The Fed did not cut rates because the Fed is uncertain about tariffs and their impact here to the market. But if you go and look at the Fed's summary of economic predictions, what the Fed said in there is they expect one, GDP to be less, two, unemployment to be higher, and inflation to be higher. You can't have the economy slowing down, higher employment. You can't have the economy slowing down, higher unemployment, and lower GDP. That is called stagflation. That is the kiss of death. I need you to be prepared that things are going to cost more and we're going to be stuck in the muck and the mire for a little bit longer. How long? I don't know, 6 months, a year and a half. But your net income and your margins are going to continue to get squeezed during this timeline. So be prepared. We're going to throw this out there as the bonus. I will tell you, social sentiment in regards to landlords in general is definitely changing. And this is a negative headwind that we are facing. Politicians are looking for votes. Politicians are looking to win and get reelected. And what they're saying is, you are the evil landlord. And in places like the Seattle Metro, where we just passed rent control, what's happening is these political ideas are now turning into legislation, which is making it harder and harder. What's making it harder and harder is as this public sentiment turns into legislation, this then comes and attacks your cash flow and your appreciation. I'm not going to stop just because of this. I do believe that things like this force us to be better professionals and they create opportunities and niches in the market. But we have to be aware of what we're seeing here in 2025. So, real estate investing in 2025, I don't want you just shooting from the hip like a cowboy. I want you to be the tactician, the strategist. I want you to execute a fully baked plan where you are doing it based on the numbers and not emotion. The ones who manage the risk, who manage all of these 9 issues and our bonus one that we talked about, are going to see more upside potential because we're seeing less investors in 2025 than we did in 2024. We talked about this in other videos and on some of our latest podcast episodes, but the small investor has the biggest opportunity in 2025. We just want to be smart and do everything we can to protect ourselves. If there's something that we can do to help you here in the Seattle Metro with your investing or nationally, just let us know. And as always, drop your questions and comments below. We're happy to answer what we see in today's market.